Thank you so much, Kesha, and welcome everyone to our session, which is to discuss and explore how green, social, and sustainable bonds can work within the housing sector. Maybe we could start off with a round of introductions, and I'll introduce myself. My name is Chris Kandie. I work for a firm called Lionshead Global Partners. We're an investment bank, fairly and focused on the emerging markets, but more specifically on Africa. Within Lionshead, we cover two main divisions. On one part, we are an asset manager. We have what we call the Africa Local Currency Bond Fund, which I'm pretty proud to say has invested in quite a number of issuances across Africa. Two of our investees, both TAF and Care Mercy, are here with us, so quite proud of that. But when it comes to our role as financial advisors, we've been very active in the housing sector. More recently, we've walked the journey with Care Mercy, helping them from the point in time when they started to operationalize. And actually this year, we were part of the team that advised them on their first bond issuance. So maybe I could ask Ilona to give a brief introduction of herself, a bit of a professional background, and what she does at TAF. And then we could go to Johnstone to introduce himself.
Hi, Chris, and morning to everyone, and thank you, Kesia, for that brief introduction. I think just to say, disappointed not to be in the room as part of the conversation. It does feel a little bit like one is on the outside looking in, but I've been fortunate enough to listen to some of the conversation this morning, so excited, I think, to be part of this conversation. So I'm Ilona Roodt, I'm the CFO at TAF. TAF basically is a mortgage finance company, and we lend to entrepreneurs that acquire and refurbish rental inner city housing stock. I'm an accountant by profession, and I think more recently have really had an interest in the energy and the climate change process. So busy looking at doing some studies, a master's in energy leadership, which I found really valuable and interesting and relevant, I guess, in the space that we operate in terms of how we raise capital, particularly positioning that and leveraging off the impact that we have as an organization.
Okay, thank you very much. Over to you, Johnstone.
Thank you, Chris. And I think I don't need any introduction because I was here earlier. So, if you want to know, my name is Joe Oltetia. I work with the KMRC in Kenya. Thank you.
Yeah, thanks so much, Johnstone. So I think as a way to set the scene and, sort of to tackle the subject matter for today's topic, especially for this particular panel, maybe it's important for us to sort of have, at a very high level, an understanding and the distinction across the board between what people view as green bonds, what people view as social bonds, and what people view as sustainability bonds. And I'll try to be as high level and relatable as possible without going too deep into sort of the specifics on this. But that said, I think when you start off with green bonds, I think the last panel really covered quite a bit around that. There's a very clear use of proceeds from capital raised, that's a debt instrument in the bond market, that goes towards green projects. So for our particular case, we're talking about housing, but of course there are other sectors which you could see green bonds being used at. So there's renewable energy, which is a very big sector when it comes to green bonds. Wastewater, there's also quite a bit in the clean transportation business. So there's quite a big spectrum of what could be used on the green bond as instruments. The thing which distinguishes this from, for instance, typical bonds, there are certain principles within which these issuances are had. So on one part, at a global level, we have the green bond principles, which have been set out by the International Capital Markets Authority. But when you come to at local levels, if you look at, for instance, the case of South Africa, the JSE has set specific standards when it comes to green bonds. Same thing with Kenya. You have the the Nairobi Securities Exchange, which has its own set of green principles. So there's also an element of local guidance when it comes to green bonds. So if you go further into what social bonds are, there is a very clear view on using a bond instrument, but with a very clear and specific focus on social outcomes, and there is a very targeted approach in terms of who the beneficiaries are. So you could be talking about people from impoverished communities. You could talk about outcomes that are very specific, for instance, to certain groups like women. And again, it has a similar cross-cutting sector focus. So you still have, for instance, now you'd have housing focused within the social segment. And that I think we can talk a bit more, and Ilona will speak a bit more about it, as well as other things like improving access to basic infrastructure and services. So there's a very clear social component to this, a very clear focus on achieving things like SDGs. And again, from a standards perspective, at a global level, there are social bond standards. When it comes to sustainability bonds, it's a mix of both. So what we've talked about on the green side and on the social side are there. Your typical issuer for a sustainability bond would be a financial institution like a bank, but clearly when it goes out to the market and tries to raise capital from investors, there's a very clear focus on it meeting certain standards. So if you look at the bond prospectus and the covenants which for instance, the issuer would tie themselves to, they would say, for instance, we have this particular target on the social component. We want to give out X number of loans with very clear social impacts and of course, going towards, and which are also measurable and verifiable. Same thing could also be a mix of green projects where you want to finance X number of houses, be it developers or the mortgage side, and with very clear impacts. So that in a nutshell kind of gives you a good idea and sort of separation between all these particular instruments and sort of categories. Now, sort of to go to the questions, and we'll start with you, Ilona. Maybe just give us an idea of what TAF has been doing, generally speaking, within the capital markets in terms of bond issuances as a source of capital, but more importantly, maybe dig a bit deeper in terms of what you've done within the social bonds space, and give us a bit of flavor on the framework which you've developed and how that works, and and what your experience has been. So over to you, Ilona.
Thank you, Chris. I think perhaps just to start to say that historically TAF funded its mortgage lending business through bilateral funding, but to really leverage capital and the scale of funding that's needed to grow the mortgage book to our 10 billion objective, we have found sort of developing our funding architecture and framework invaluable in attaining large levels of capital and raising capital. And working with our Rangers Standard Bank, we have taken, it would be our second securitization structure to market, which was in March 2021. But essentially it was the first sustainable bond listed on the sustainability index of the JSE. And just to go into the framework in a little bit more detail, I think, Chris, you touched on the importance of some of the qualifying criteria, and as a foundation, our framework links to the International Capital Market Association green bond and social bond principles. And then specifically, there would be particular components of the framework, like definitions, what we regard as affordable housing, and the particular eligibility criteria that need to be met for an asset that is funded to be included in a funding structure. And those particularly are the underlying asset must meet the criteria for affordable housing, financial inclusion in terms of lending to clients based on BEE principles, improving access to finance, particularly for small businesses and small-scale operators. And I think particularly then on the green side, so it's a sustainable bond framework with a focus on, we could do either social issuances, which we have done initially, and because it's a sustainable bond framework, it obviously also then includes the green element. So it would be green accreditation with a focus then on renewable energy, looking at solar and energy efficiency. It could include things like adoption of heat pumps that would result in energy savings and reduced carbon emissions. So essentially those are some of the qualifying criteria that would need to be met for the bond for the assets to be funded through those qualifying criteria. There would be an asset selection process that we make, and one of the criteria would be that there has to be positive cash flow. I think in terms of securitization transactions, that would be vital. So we would need a mechanism to first fund construction, and then for the loans to qualify for these, for the bond framework, cash flows need to be positive, and they also need to meet our lending criteria, particular debt service cover and LTV criteria. And in terms of reporting, there would be a particular component in terms of reporting through to the JSE annually in terms of the requirements of the framework. But I think, the use of proceeds is a cornerstone to the framework in the sense that we would use an independent external service provider. We have used ISS ESG successfully over the past years to provide the assurance, essentially, that the funds that we raise are used for the purpose of the assets and are used exclusively for the assets funded. So those are some of the cornerstones, and I think linking the reporting through to the UN SDGs is a final component. So I mentioned some of the social impacts that we measure. It's broader than just affordable housing and the units that we finance. It's broader than just the number of entrepreneurs that we finance. It extends across to job creation, the number of women entrepreneurs financed, training. So there's a huge amount of impact as an organization that we recognize through the framework, which I think is important when we are engaging and building that track record with investors. So Chris, I think I'll pause there.
Yeah, I think that's a very, very adequate response to this, and I think we'll come back to that in a different form. So for you, Jo, I think in as much as you've not gone down the road yet when it comes to green bonds, you have experience within the bond market, and I think just for the audience's information, KMRC did its debut bond earlier this year. It was very well received with over, sort of 400% subscription. Maybe just and for debut bond issuance, that's a very strong signal. Maybe just for the audience, it could be good to understand, one, what led to this level of interest, and then two, what the journey was like, in fact, to get to the point where, as a debut bond issuer, you actually attract that level of interest. So maybe a bit of a retrospective on that, and for the audience sake. Yeah.
Thank you, Chris. So when you look at the bond issuance, I think one of the most important things anyone will want to do when you go into the capital markets is to have your intentions very clear. The objective certainly has to be clear all the way from your governance. We set out to issue bonds after we already have mobilized concessional financing. But the intention is actually two. Number one is to enhance sustainability of the institution by having to mobilize local resources, essentially long-term for, in your funding structure. Number two is a development objective, which essentially helps to develop the local securities market. Now, when we started off the process, obviously the first step is to ensure that you have a team of advisors that will help you essentially bring the transaction to the market. And we're very glad to get a very good team in Kenya, including, in fact, Chris here, who are part of the advisors that help us to bring the transaction to the market. But then you obviously have to build the market to understand your intentions and certainly to accept the offer. So we had to do roadshows, actually a number of roadshows, to kind of build capacity of the market to have a lot more clarity. KMRC was essentially a first-time issuer. It was, at the time, in fact, a new institution. So we had a significant challenge of convincing anyone why an institution which doesn't have a track record in the market will come in now to issue a corporate bond, and yet there are a number of corporates within the country that are doing that. So when you look at building consensus, building the market to appreciate your offer, you have to have a very good clarity on, who essentially is part of your governance, because you need to have a strong governance framework within the institution, and the kind of partnerships that we build within. So we were very lucky because we had not only the government of Kenya as part of the shareholder of KMRC, but we had greater partners within. We had World Bank, for example, who we had to keep mentioning at every conversation, because that's one of the ways of building your credibility, because you didn't certainly have one initially, because you're completely a new issuer in the market. So going to your second question, and as to what could have led to the 480% of a subscription, number one is market timing. So we had a number of corporates, actually 2 corporates that had come to the market before us. One was actually coming to the market at the same time as us, an institution called East African Breweries, which is essentially a very large company. And we had to hold on, But more importantly, we had to ensure that we have timed the market sufficiently for us to go to the market potentially alone. And I think it's not a unique issue to Kenya, but a number of us, the government tend to crowd out private investors in the market, especially private companies. Because, when you have significant fiscal deficits like what we have in Kenya, the government is always in the market. And when you have government in the market, what that means is that you then have a challenge as a corporate going to the market, especially when you're looking at benchmarking your instrument against a sovereign. And what you're doing is, because you're talking about affordability, you want the markup to be less. And anyone will want to put the risk-free instrument quickly. Now, so when we went to the market, of course, the market had super liquidity. So I think that's one of the contributions that led for us to have a high oversubscription. But a lot more also has to do with diversification of investment. So the KMRC bond was considered a housing bond, and that more or less was another asset class, where particularly pension funds were coming in to put in investments. So the diversification aspect, I think, also helped us in the process for certainly getting the higher oversubscription. But again, it is more about the credibility you build. We had a credit rating, which was very good, and that also potentially contributed for KMRC to be considered highly. But also, when we were doing the credit rating and when we were having investor conversations, we significantly highlighted the low-risk nature of KMRC, because any investor will obviously want to look at your risk profile. And we demonstrated the fact that KMRC is a very low-risk institution, and the fact that we channel financing to only a single line. So funds we raise just go into one, because it's a single-purpose institution. The funding will certainly go into housing, supporting housing through mortgages. Now, most of the questions you tend to receive actually lies around there, because some institutions or issuers go to the market and actually raise funds, but then sometimes they divert the funds to other uses which are more pressing. But certainly our case was very clear on where we'll allocate the funding. Thank you.
Yeah, thank you very much, Johnstone, on that exhaustive response. So over to you, Ilona. I think for this audience, I think people are very curious to understand how your first social bond issuance went. So just a bit of background, TAF went to the JSE, that's the Johannesburg Stock Exchange, and raised over 600 million rand with the Urban Ubomi 1 social bond. So first of all, just building up on the response you gave around the framework, just give an idea to the audience how your first social bond was structured, and then also a bit of flavor on the key issues you faced taking this to the market. So how did the investor community receive this particular issuance? How did the regulators look at this? And it would be just great to understand a bit of background on those particular 2 points.
Thank you, Chris. I think firstly, there is an established securitization market in South Africa, and the Urban Ubomi structure essentially issues listed rated notes as part of a securitization structure. So you would have different classes of notes rated from AAA, AA, B notes, as well as a subordinated position that TAF would take, essentially a first loss position. So, and essentially then these notes would be issued to institutional investors, mostly the asset managers, that would then, the proceeds would then be used to acquire the qualifying assets as outlined in the Sustainable Bond Framework, either from TAF directly as the originator or from our warehouse structure. So I think that is, in a nutshell, the essence of the structure. And importantly for growth, we think, using the capital markets and this mechanism will, over time, it's about a 50-50 mechanism to fund debt capital presently, but over time, our objective is that this would fund up to 70% of the funding that we need. I think, a key component of some of the key issues would be to partner with service providers that have the experience and the skills to position the offering to the market. So that would include, making sure that you choose a reputable arranger. We work with Standard Bank, and also then partnering with service providers or partners around positioning the impact elements. So I think Chris had mentioned that we had done some work with Lionshead initially in setting up our green program, and we are continuing as well to work with them and the IFC in setting up a green fund. So it is really partnering, I think, with credible organizations You know, from a legal perspective, we work with a corporate lawyer in South Africa, Weber Wenzel, and they would obviously sign off on the regulations, securitization regulations, and the legal opinion that we need to provide to investors. I think those are some of the important components when deciding to take the structure forward. I think it's also vital that the data and the reporting that we need is, you know, that we have world-class reporting mechanisms. We've got a tailor-made system that we have in place to access the data that we need to do, to analyze the recovery data, to look at the default data, all of those, that parcel of information in providing through to rating agencies is vital to be able to continue as a regular issuer. I think historically, through the many relationships that we've built through our bilateral lending on balance sheet directly, that has proved important as we go to the capital markets, because a number of the investors in the structure are also investors that we have existing relationships with. But I think what's vital for us going forward is attaining sort of capital market standards in terms of reporting, and our key objective would be to build our track record. We're about to do our 5th issuance in the market, and a key objective would be to continue to grow the investors that participate through a track record, and that takes time. It's ongoing, keep chipping away at that, ensure that we do what's required, report where we are required to report, and partner with credible partners to continue slowly but surely to build that track record and grow our issuances.
Yeah, thank you so much, Ilona. And I think it's worth underscoring the importance of, you know, sort of having the right team, and also, more importantly, building the track record, which I think for any, you know, financial institution or issuer is really key in gaining investor confidence. So, I mean, switching gears a bit to you, Gio. I think when in the previous discussion, the issue around green pipeline, especially for institutions like yours, is really critical. And I mean, I had the pleasure of being part of your housing conference last week. And in Kenya specifically, the government, through its affordable housing program, is trying to drive all the new projects that are being driven by government to be green and affordable, according to the the Principal Secretary, Hinga. Just with that in mind, I mean, how do you see that, of course, helping you drive pipeline? And then two, what do you see, with that in mind as well, when do you see KMRC being in a position and to actually issue a green instrument on the basis of this pipeline that's growing? Like, is it, you know, what does the timeline look like? Yeah. So maybe you can start off with that.
Thank you, Chris. So I think when you look at the situation in Kenya, we actually have a policy, legal, and regulatory environment that is ready, that is sufficient to support issuances green. Now, the issue that we are still grappling with, which is part of the issue that we raised earlier, is just supply. So green housing supply continues to be the most significant challenge. We have to keep driving, especially capacity building, creating awareness on the importance of green as part of the discussions to enable people to start, you know, appreciating the need for greening housing. Now, as we build into that so that we can actually build a sufficient pipeline for refinancing, I think the other critical issue that we have to deal with is market timing. So we're not too sure when we are going to the market, but we have every intention to, you know, raise a green bond. In fact, we could raise a green bond as part of our next tranche if we got a pipeline for green affordable housing today. We could go to the market immediately in the beginning of the year for that purpose. But what is holding us is something that we are unable to drive. You know, we can try, but it's supply. Other people are actually meant to be doing that. And that's why we are trying by bringing everyone together to see how they can be incentivized to start building green. So we'll have to keep timing. We'll have to keep supporting in whichever way we can to get the supply going. And once we have very good visibility of that supply, we'll essentially hit the market immediately with a green bond issue.
Okay, thanks very much, Johnstone. So I think those are sort of the discussion questions we had. I'll be very happy to get questions from the audience. So yeah, I think there's a gentleman there. There's a lady over there. There he is.
Thank you. I have two questions. Always has been said. My name is Patrick Sewatigita. So I have two questions. The number one question is to say many African countries have a different regulation when it comes to capital markets. How do you see the different funds operating cross countries? Is it something that may be possible in the next future? A fund issuing a bond, an East African fund issuing a bond in West Africa, for example, in another jurisdiction. Second question, I'm coming back to the previous panel, but I think the question is addressed to KMRC. Are you looking also, have you considered looking at rent-to-own kind of scheme? Because it looks like you are more focusing on green mortgages as an intermediary step to start coming into the market. But are you contemplating also acquiring assets directly on the rent-to-own through specific vehicles? Thank you.
Maybe you can take another one or two questions.
Hi, my name is Mary Lee. This question is for Ilona. With Taft partnering with the IFC for a green bond, will this give preferential interest rates to the developer or the end user? Because what I've seen in South Africa, quite a few banks give these green bonds, but the benefit only affects the end user. So if you're doing a development, there's no real benefit for the green bond, but if you are doing a rental portfolio, then the green bond and the preferential rates sometimes kick in.
Okay, thank you. I think there's one more question over here.
Okay, thank you. My name is Jacques, and yeah, I was very interested by the response of JO on the KMRC. I think how investor received the bond, perceived the bond. Initially, I was very skeptical for the reason that you mentioned about the government crowding out. I think there is even more to the government, issuing bond like quite often. But if you look at the yield curve, like in Kenya, the coupons that are being paid on infra bonds, like now we have reached 14%. And for the KMRC bonds, I guess, your coupon was a bit lower. So if you compare a sovereign to KMRC, which is, I think, also probably backed by, I don't know the specificity, but maybe backed by the sovereign or a state-owned enterprise, I was very skeptical when you went out to issue because I was like, hey, you are being crowded out. But you managed to secure, 400% subscription. But my concern still remains, like if government continues, to maintain the yield curve where it is, I am quite skeptical, you could continue to issue at that, level of subscription. Now, maybe another thing that I want you to know, I think maybe you could share some light. What is the profile of the investors? Like, did you have banks investing, because they want to diversify away from government bonds in low-risk assets? Were there international investors who are not aware of the situation, where they can get 14 or 13% net of tax? So this is, I think, my question and some reflection. Thank you.
Thank you very much. Maybe Jo could start off with, I think, Patrick's question around regulations affecting cross-country issuances. I think wearing your hat previously from your life as a regulator, and then KMRC and RTOs. How can KMRC get into it, and what issues do you see? And then I'll get the rest of the questions. Yeah. So the second question is on KMRC, what it can do to support RTO schemes.
Thank you. So on the cross-border issuances, that's already possible in Kenya. So the regulatory framework provides for that. But the challenge ordinarily you face is the forex costs. But at the moment, you can actually, any institution can actually issue a bond anywhere. Of course, it has to have a business case for that to happen. And for any investor outside Kenya can actually invest in a bond or any sort of instrument whenever they're issued in Kenya. So both ways apply. So you can invest in an instrument in Kenya that has been issued, and any institution can actually issue a bond if, obviously, the other jurisdiction where you're issuing it happens. So far, I think we've seen sovereign bonds issued by the government. I'm not sure I remember any entity which has issued a bond outside, but the issue is actually having a business case for that kind of arrangement, taking into consideration the forex cost or risks that they apply.
Maybe, Jo, is there a specific, for instance, in East Africa, is there a specific framework where you could do cross-border issuances? So, say a Rwandese entity issuing in Kenya, that kind of thing.
Oh, yes. We actually have had some entities. There's an energy company in Uganda which issued a bond in Kenya because obviously the market is deeper. So instead of issuing in Uganda, they came into Kenya to issue. And a number of Kenyan companies have actually also done cross-border issuances. So they issued a tranche. So they issue a bond in Kenya that is approved, and a tranche is issued simultaneously in Tanzania, for example, in Rwanda or Uganda. So that's completely happening right now. Now, when you look at the discussion or the question around TPS, it's like you are part of our discussions. So we've been having discussions around rent-to-own and how to support rent-to-own. But the applicability of that for KMRC to support is predicated on having an intermediary, because the nature of KMRC, or in fact any MRC, is a wholesale financial institution. So the idea is we lend to other institutions. In most cases, they are prudentially regulated institutions. And the reason why they are prudentially regulated is because of the risks, the management of the risks. So you have an additional regulator that looks at the risks of the various entities, and that's why they have to be prudentially regulated. The idea is to actually have lower risk, because the moment you have lower risk, then the investors, when you're issuing bonds as potentially a frequent issuer or an issuer of record in the capital markets, they will see you as a low-risk institution, and therefore the cost of raising funds will be lower compared potentially to any other corporate. And that's why we keep insisting on having very low risk. So there are currently discussions in Kenya between KMRC and other entities actually on looking at the potential for us to be able to support rent to own. So those discussions are currently inconclusive. Coming back to the other question about the crowding out effects and the yields, and that's very accurate. We have a problem with that. And that, I think, continues because of the situation we have on the fiscal deficits in the country. So government, from time to time, obviously have to go to the market to raise funds to take care of other social services. But the idea is, while there is that potential for crowding out, we certainly have to do market timing so that you go to the market at an appropriate time when you have liquidity. Now, the yield, of course, remains, of course, as the government goes to the market all the time and the government need for funds will increase, naturally will increase the yield. Now, when that happens and you have to benchmark against that, then you have a problem of affordability, because that continues to be the biggest single hindrance on raising of funds. We are talking about supporting affordable housing, but when you go to the market to issue bonds, it's not cheap. So certainly government has to do something, to make the economic conditions better, potentially reduce the rates so that then you can be able to issue the bonds. So the other question, I think you said the profile of the investors. The majority investors for KMRC bonds were actually pension funds. So they found a mechanism for further diversification of their funds, and they actually like the story. They tend to be appearing to be supporting a social objective, if that appeared to be a social bond or something like that. But that notwithstanding, we had a number of others. So we had some external institutions that came in. We also had banks. So a number of banks in Kenya obviously were also diversifying, and they came in to invest. But we also had individuals. We had a number of individuals actually who invested in the bond. So that's how the profile of the investors look like.
Okay, thank you. And over to Ilona, I think the question from Mary Leo was around, sort of passing on the benefits of the preferential rates you're getting from the social bond.
Yeah, absolutely, Mary Lee. I think the work that we're doing with the IFC is, we saw in the inception stage, but quite far advanced. We expect to close out those discussions early in 2023. But essentially, we think that there would be two benefits. There would be, from a cost of funds perspective or an incentive to the landlord, there would be a benefit in terms of the donor funds that form part of the funding structure, and also utilizing the MAGIC program. But I think secondly, we do think that there will be an incentive to tenants as well, because obviously most of the costs for electricity, for metered services in the building, water, are passed on to tenants. And we think through the adoption of the green bond mechanism, that will end up or result in cost savings in tenants' hands as well.
Okay, so I think we are out of time. Yes, we are. I'd really like to thank Ilona joining us online, and of course Johnstone for sort of gracing this panel, and of course the audience for the great questions. Thank you very much.